Hi, and welcome back to our Mailbag series. I'm Dave Lopez.
And I'm Chase Lopez, and we're financial advisors with ILG Financial. And this is another episode of Retire Your Way with ILG Financial, where we talk all things retirement planning. All right, let's jump into the next one, Dave.
Okay.
This one says, I'm a big believer in my current company's future, so the majority of my 401k is invested in company stock. I understand that I'm not diversified, but isn't that okay since I know the company so well? So I'll start off on this one, if that's okay with you. So you in your question, you kind of alluded to some of the things that we would draw to your attention. One of the things that we talk to a lot of people about is when we're invested in the market, and that's in a stock or just in the market in general. There are two types of risks that you have. The first is what we call systematic risk. And systematic risk is basically what happened in 2008, right? When the market started going down and started crashing because of the great financial crisis, pretty much all of the market started to go down.
The whole system.
Exactly.
Cracked. So your risk is to the whole system going down. An easy way to remember that is if you're in a harbor, right? If the tide goes out, all the boats go down, not just the bad ones or the good ones. That's systematic risk.
Right. And diversification, to your question, doesn't really help with that risk.
No,
right?
08 was the perfect example.
Right. The other one is what we call unsystematic risk, which just means something happens with a particular company. We can talk about your company or any company, really. Something happens in particular to either their business or maybe the sector that they're in, and that directly affects that company's stock price, right? Independent of what's happening in the system overall. So by having your 401k largely put into the company stock, you're taking on that kind of additional risk. Diversification helps with that risk. So that's just something that you most certainly want to be aware of.
Well, you said it right perfectly though when you said, and I want to make sure we highlight this. You said you take on that additional risk. It's additional, right? If you're in one company, you're still exposed to systematic risk.
Great point. Yeah.
You're now, in addition to that risk, you've added unsystematic risk, right? And it probably is a great company,
right?
But we've got a laundry list of horror stories of great companies. It could be embezzlement from within. Right. And maybe the people that are running the company are great today and they're not 4 years from now. Right. You could look at Citigroup was considered a stalwart for years and it lost 70 to 80% of its value in 08. But no one thought that could ever happen. Enron, the one I like to think about all the time is BP, right? That people thought, well, how can I go wrong with a big energy giant like BP? And then somebody drops a wrench in an oil rig out in the Gulf of Mexico, and then you have that whole mess, and then that's a problem. So you avoid unsystematic risk by spreading out over an entire sector. I would suggest, to Chase's point, if you love that company, keep some in your company. And if you really like the sector your company's in, diversify into the entire sector. Let's just say it was energy or defense, right? Because what you're saying, if you like your company, is you're also saying, I like the sector they're in. Looks like there's going to be growth, the industry. So,
and I think one thing that you have to keep in mind is your time horizon with all of this, right? If you're getting close to retirement, I think you need to have a serious discussion about, hey, I'm taking on this additional risk and I'm almost to retirement. Now, if you just started working for this company and you have a 20 or 30 year runway, I think you could take a little bit of a different tact there. So that's something that you definitely want to take into consideration as well when you're making this decision about the company stock versus being diversified.
I agree.
All right, perfect. Let's jump into the next one here, Dave. This says, I've been loving the growth in my 401k for the past several years, despite the volatility. But I just don't know how long the ride can last. Quite frankly, I can't believe it's lasted this long. When should I walk away from this quote-unquote roulette wheel?
Okay, wow, that's a good one. So a lot of buzzwords. Yeah. And it's telling if anyone listening kind of feels like that. The the biggest challenge I would say is our view of the market is by nature, it's volatile.
Right.
So think of the tide. You have high tide and you have low tide. And you can go to the beach and say, I'm disappointed that there's no waves.
Right.
Okay. It is what it is. That's the nature of the tides. Right. You just have to wait and be patient, and high tide will come back. That's how we see the market historically, and the data over the last 100+ years support that. You're going to have times when the market overperforms, like now for this reader, right? And usually what happens, think of it almost like a pendulum. When it swings, it always swings too far in one direction, right? Because we love to continue momentum, right? And then now we overcorrect to the upside, which means when it crashes, it's the more we overcorrect, the bigger the correction, right? And it's called, in our industry, reversion to mean is a fancy term, reversion to mean. But then it gets back to maybe where it should be, and then it overcorrects on the downside, which is why once the market bottoms out, it's a big jump initially, because it's everyone see now, oh, we have overcorrected. So to that point, first thing I would tell you is, if you feel like that, if you're looking at the market, like timing it and getting in and get it out, you might as well be in Vegas playing roulette. I've never met anyone who can effectively and consistently time the top and the bottom of the market.
Agreed.
Even close to it, and we certainly can't. So when we work with clients, what we tell them is, we're going to build out an investment strategy, and your portion of your funds that are in the market, we're going to use a strategy assuming we can't time the market. Now, how do we do that? We build out your strategy so that you can ride out high tide and low tide. A short answer for you would be, whether the market's up or whether it's down, if you're not willing to put your money in the market, that portion of your savings, and leave it untouched, no matter what's going on in your life, for at least 5 to 7 years and maybe more, you have no business being in the market for 5 minutes. And the reason is because you don't know when it's going to crash. It may, to your point, go another 3 years. And it may happen tomorrow.
Yeah, and I think your point is taken, where really the experts don't even know, right? It's a fool's errand to try to time it, the top and the bottom. So I think you make a great point about someone's time horizon, right? If you're willing to sit in the market for, today's point, 10 years, then just know there's going to be some bumps in the road, and just be okay with that. And you continue to kind of push on and still contribute to your 401k. With the 401k specifically, as you're contributing, right? And if the market were to go down, well, now essentially you're buying, the market, right? The mutual fund, whatever you're in, you're buying it, at a quote unquote discount, right? If we assume that it's going to, recover at some point. So with the 401k specifically, as you're making those contributions, if you have that long time horizon, and you're okay with that volatility, I wouldn't try, to your point, Dave, wouldn't try to time, the top and the bottom. All right, so Dave, that does it for our mailbag series. Go ahead and hit the like and subscribe button down below to be alerted for all of our future videos, and we'll talk to you soon.
Talk to you soon.